and I'm one of the tax partners here with the firm, and we welcome you to our webinar on the top 10 things to consider for tax and accounting in 2021. We will discuss many topics that will be relevant as we plan for the upcoming busy season. We will be fielding questions during the session and as well as at the end of the webinar. So if you would like to pose a question, please use the chat function, and that your question will be directed to the person that most best can answer the question. If you have a question that comes up after the presentation, feel free to reach out to any of us, and we hope you enjoy the webinar. For those of us who are CPAs and would like to get CPE credit for today's session, we have to read this disclosure from the Board of Accountancy. It is the responsibility of the licensee to be accountable for the hours earned during the CPE course. The licensee should not engage in any other activities that would denigrate the learning objective of the course to the licensee or of others. If the other activity is unavoidable, then that time should be subtracted from the overall CPE credit. We encourage everyone to fill out the online evaluation form that you will receive at the end of the session. That feedback is greatly appreciated, and that helps us to plan for future CPE events. And with that, I will turn over the first topic to Bill West.
Just realized I was still muted. Okay, this is the tax relief for pass-through stakeholders, which is the recently passed South Carolina legislation to permit pass-through entities to deduct taxes at the corporate or entity level. This was caused by the Treasury issuing a notice back in November of 2020 that said that specified income tax payment is any amount paid by a partnership or S corporation to a state or political subdivision of a state or the District of Columbia to satisfy its liability for income taxes imposed by the domestic jurisdiction on the partnership or S corporation. So in response to that, the South Carolina legislature passed an amendment to let's see, 12.6.545G, effective for tax years beginning in 2021, that permits a qualified pass-through entity to elect and pay an entity level tax of 3% on active trader business income, apportioned to South Carolina. It's an optional election for certain pass-through entities to report their active trader business income directly on the entity's tax return, pay the income tax at 3%. The South Carolina tax paid is allowed as a federal income tax deduction by the pass-through entity in the year it's deemed paid. This effectively bypasses the SALT cap of $10,000 on people who itemize for state income taxes owed on that portion of the ATBI. That portion of the ATBI is then no longer taxed on your South Carolina return. You actually make a South Carolina return adjustment to remove that income from your South Carolina taxable income. So this can apply to both partnerships and S corporations. It does not apply to personal service income. So therefore, a partner with a guaranteed payment cannot use it for his guaranteed payment income. He can use it for his residual partnership income. It presumes that an S corp shareholder owner is receiving adequate compensation, and the notice put forth by the Department of Revenue specifically states that there has to be adequate compensation to owners. So this thing effectively saves federal taxes. It does not necessarily reduce your state income taxes. There is one problem with this, in that if you have a person who has multiple entities and they make the election for one entity and they have a second entity that is a loss entity, then you have to adjust on their individual return that you can only deduct those losses at 3% rather than 7%. And I can tell you that I'm not exactly sure how that's going to work on the South Carolina income tax return. I don't think the form designers have actually dealt with that yet, based on the drafts I have seen. Very quickly, let's talk about what you got to be as a qualified owner. That is basically any shareholder or partner that is an individual, estate, or trust. So if you have a partnership with a corporate partner, that partnership cannot elect this provision. Later in our discussion, we will talk about the SALT cap and the potential for lifting the SALT cap or raising the SALT cap, which may render this less valuable to people. Obviously, if the SALT cap goes away, only in very rare circumstances would you want to consider doing this, primarily because its only real benefit then would be that it lowers your adjusted gross income, which of course lowers the threshold of certain deduction items. So with that, I think I will pass it back to John.
So the employee retention tax credit was something that came into the law back in 2020 as a way to help employers keep employees on payroll during the pandemic. It is a payroll tax credit, not a income tax credit. So it's not something that's going to end up passing through to shareholders or partners, or be shown as a credit against income taxes, say on a C corporation. Who is eligible for the credit? The credit is for those businesses that either A, had a partial or were fully shut down because the government said you had to be shut down, or for those businesses in 2020 whose gross receipts for any calendar quarter, for that calendar quarter beginning after March the 3rd, so basically the second, third, or fourth quarter of 2020, if your gross receipts for that quarter were 50% or less than the gross receipts for the same quarter in 2019, or in 2021, those gross receipts were 20% less than the same applicable calendar quarter in 2019. So the credit could be taken on wages up to $10,000 per employee in 2020, or up to $10,000 per employee in any quarter in 2021. Now, this law was supposed to be applicable for all 4 quarters of 2021, but the infrastructure bill that was signed by the president on Monday took away the 4th quarter. So that's only applicable for the first 3 quarters. And this credit is taken on a payroll tax return, i.e. the 941, not as an income tax credit. So you're saying, well, I've already filed all my payroll tax returns for those quarters and I didn't take it. Not a problem. You can go back and amend your 941s to get those credits. If this gross receipts test, you can meet it for any quarter. So if, let's say, you met it in the 2nd quarter of 20, didn't meet it in the 3rd quarter, but you met it in the 4th quarter, you can go back and amend your 2020 2nd quarter 941 and your 4th quarter to get this, because it's a refundable credit. Basically, it's a credit that will give you the money back for. And then the same thing with the 1st, 2nd, or 3rd quarter of 2021. So this is something that's not, some people think, well, it's over with. Well, it is as far as being eligible today, but if you're eligible for any of those basically 6 previous quarters and you didn't apply for it, you can do so now. And with that, I'll turn it over to Don Mobley.
Good morning, everyone. I'm Don Mobley. I'm the managing partner here at Scott & Company. We're based in Columbia, but we don't let that stop us from doing work in other places in South Carolina and, in fact, other places in the United States. We have clients as far away as Boston. So we're in Columbia, but we travel everywhere. I'm going to talk to you just a minute about lease accounting, and everybody's been hearing about this since 2016, but it's finally upon us for private companies, not-for-profits, and governments. The public companies had to implement this a couple years ago. So what is lease accounting? It's basically taking all leases and putting them on the balance sheet. And while capital leases have been on the balance sheet for a long time, operating leases have not. Now there will be a liability for operating leases and capital leases. Now they're called financing leases. A quick story, I had a client in the early 90s that built a very nice corporate headquarters, $30 million. They were a public company, and they wanted to keep that off the balance sheet. They want to keep the debt off the balance sheet. So they set it up as an operating lease, and therefore it did not get on the balance sheet. And so it didn't show up in their debt to equity ratio with the analysts. That's one reason that they're doing this. And so it's taken them, shoot, that was 30 years ago. So it took them 25 years to come up with a standard, but I think a lot of people were doing that. Who does lease accounting affect? It affects pretty much everybody. Commercial, nonprofit, government, public, and private. Why is this important? Well, I think it's a better representation of your balance sheet. You might want to, when you do this and decide to implement this and how you're going to do it, you might want to touch base with your auditors just to make sure they agree, so that when they come in after year end, you won't have an issue. Who does lease accounting affect? Everybody that has leases, they're over 1 year. What is the deadline to adopt the lease accounting standard? For private companies, it's December 31st, 22, but you really have to start doing that January 1st of 22. So you got a month and a half if you haven't started. I would imagine that everybody has started worrying about this process, getting prepared for it. If you haven't, there's still time. There's a lot of software out there that makes this pretty easy. So if you haven't considered that, I don't think it's that expensive. There's a lot out there. You can just Google lease accounting software, and a lot of different products come up, and you'll just have to look and see which one suits you the best. But you basically plug in the data to the software, and it does all the work for you. I mean, it generates the journal entries, and it even generates the footnote for you. And that's one of the things that has changed a good bit, is the amount of information that you have to disclose related to leases. That's changed significantly. So if you get that software, it does all that for you. You just gotta make sure that you've got all of your leases. And there can be leases and an embedded contract. So you need to make sure you've got those too. But once you have the right population, and if you plug in the right data to that software, you should be set. If your year end is not 12/31/22, then it's effective 6/30/23. If you have your June year end, but for governments, it's 6/30/22. And governments are under a completely different standard. I mean, it gets you to the same place, but it's a completely different standard. So anyway, That's all I had. Obviously, that's if not enough. You can go 8 hours on a CPE just for leases. But I would now like to turn it over to John Price for proposed American Families Plan.
So we've heard a lot about tax increases, or what do we want to do about taxes? This started way back in after the election. There was all kind of proposals. We're going to go do this. We're going to do that. I mean, they've been all over. It's been all over the map. It's about individuals. It's about estates. It's about corporations. There's been a lot of talk, and a lot of this talk that went on then was met with a great deal of resistance. So now we're just looking at what is it that they are actually looking at doing today. The House is supposed to be taking up this Build Back Better bill this week, and they want to have it at least over to the Senate before the Thanksgiving break. So here are the highlights from the proposed plan. The child care tax credit that was expanded or increased with the legislation at the end of last year would be expanded by another year. The amounts would be the same, but instead of it only being applicable for 2021, it would be applicable for 2022. The only other thing that really is kind of I'd say a beneficial thing is, like Bill mentioned earlier, is the SALT cap limit deduction. And SALT stands for state and local taxes. And currently, a person who can still itemize their taxes on their personal return can only deduct up to $10,000 of property taxes, that being real estate, vehicle, and state and local income tax. Well, there's a lot of states that have high income taxes that have never have liked this provision that was passed in 2018. And so they're looking to say, hey, what about us? What about our residents? So instead of it being $10,000, they're looking to bump it up to $80,000, which, is a significant increase. And this is the only provision that I'm aware of that actually would be applicable for 2021. So we'll have to see if that actually passes, and if that would actually help a lot of people who, because of this limitation, have not been able to itemize their deductions, because the standard deduction has been greater than the total of their itemized with this $10,000 SALT cap. So we'll see about that. The other things that they're talking about are what some people want to say, we're going to go get the rich, because they're not paying their fair share. So the first is this income tax surcharge. And they're looking to say, okay, if your AGI is over $10 million, we're going to tack on another 5% surcharge, i.e. basically, instead of at 37%, we're going to tax at 42% if you get over 10 million. And for those who are the uber rich and their AGI is over 25 million, then we're going to tack on another 3%. So they would be at 45% over the $25 million number. The net investment income tax, as most of you know, that's the 3.8%. I call it the Obamacare tax, that taxes additional on investment income, dividends, interest, capital gains, and passive income. So if you are a passive investor in some rental real estate, that income is deemed to be investment income, and it's also subject to this 3.8% tax. What they're looking to do is say, well, now we're going to tack on that income tax to active trade or business from a pass-through entity. So if you're a partner or an S-Corp shareholder, then that K1 income that you get, that you've never has been subject to what we call the NIIT, would now apply. So that's another tax increase that they're looking to potentially pass. The for those people who are fortunate enough to have at least $10 million in their IRA accounts, I don't personally know. I don't think I know one person that's there, but if you have that, they're not going to allow you to make any more contributions to your IRA account, and they're going to accelerate the required minimum distributions from those accounts. So in other words, right now you're not required to take any money out until you're age 72, but they're looking to make that age lower for those people who have at least $10 million in their IRA account. And the last thing that's trying to get, it's a political hot potatoes about all these corporations. They're not paying any taxes. So they're like, okay, well, we're going to do this is we're going to say, if you have at least $1 billion of book income, then you're going to pay a 15% minimum tax. So who are they going after there? Well, it's all these multinational corporations, the Googles, Amazons, Apple, these people that they're claiming they're not paying enough tax with it, or some in cases paying no tax through credits and other provisions. They're going to say, well, this is one way that we're going to get something out of you. Now, what they don't understand is, okay, these corporations, if they do this, they're not going to eat this. And this is just an aside here. They're not going to eat this money. They're going to pass this on to the consumer. So it's an indirect tax increase on everybody, not just that business. But, that's just food for thought there. So with that, I will turn it over to Taylor, who will talk about record keeping practices.
Good morning, everyone. My name is Taylor Williams, and I am on the staff tax here at Scott & Company. We get a lot of questions from our clients about record keeping, so I'm going to provide a general summary as well as some information on some common topics that we receive these questions about. So tax records. This includes your tax returns and your documentation. Those should be retained for approximately 3 to 6 years. Generally, the IRS can audit tax returns filed within the last 3 years with some exceptions. And if they can prove fraud, they can go back even farther. But typically with those exceptions or fraud, they typically don't go back more than 6 years. Next up is receipts. Receipts are some of the best sources of documentation. They typically provide all the necessary information to back up your data. They provide the date purchased, what was bought. They tie back to the credit card, so they can tie back to the business bank account. And the IRS requires receipts for any expense that costs $75 or more to be kept. So any expense that costs $75, you should always keep, but it's best to keep all of your receipts just to back up your data for your purchases and expenses. It's also good practice to write down information on the receipt that states why it was a business expense. So this can include the purpose of the expense. This can include for meals and gifts, which I'll discuss more in depth here in a minute. You can write down information such as who you were with and your business relationship with them. Auto deductions. Typically, these auto deductions are used for Schedule Cs and small businesses, small business corporations or partnerships. And there's 2 types of auto expense methods. There's the actual expense method and there's the mileage method. Whichever method is used, you're required to keep track of your business mileage as well as your total mileage for each vehicle that you use for business purposes. And one of the easiest ways to do this is to keep a mileage log for your business trips, and then also to keep track of what your mileage was at the beginning of the year and what your mileage was at the end of the year. That way you have your business miles, and then you can also calculate your total miles. When you're using the actual cost method, in addition to keeping track of your business mileage and your total mileage, you should also keep your receipts for your vehicle expenses. The business mileage and the total mileage is used to calculate a business use percentage for that vehicle. And that percentage is used and multiplied against your total expenses, your vehicle expenses, to determine the amount of your auto deduction. The mileage method, on the other hand, you are still required to keep track of your business miles and your total miles, but we use the mileage, your business miles, and we multiply that by the standard mileage rate that the IRS provides, which for 2021 is 56 cents. And that determines your auto deduction with that method that can be reported on your tax return. Gifts. Everyone loves gifts. However, the IRS limits the amount that you can deduct for gift expenses. The IRS only allows a $25 deduction per gift recipient for the tax year. So any amount that is spent over $25 for a gift for a specific individual is not deductible. And like other business purchases, you should keep a copy of your receipt. And some things to note on your receipt for gifts, maybe the purpose of the gift, or maybe a benefit that you expect to receive for giving the gift, who you gave it to, and their title or occupation, and your business relationship with that person. Business equipment. Equipment is typically a capital expenditure that is depreciated. However, taxpayers may elect to expense equipment that costs $2,500 to $100 or less, and this is called the de minimis safe harbor election. And this limit is per equipment cost, so it's not for your total equipment expense. However, it's important to keep record and characterize your equipment purchases separately, especially from things like your supplies and small tools, because like I just mentioned, some equipment is depreciated, some is expensed. So you don't want to mix those together with your supplies and things like that, so that we can, or your tax preparer can accurately report that. And then, as I've said before, keep the receipt for all your purchases, especially your equipment purchases. Meals and lodging. When you're traveling for business, lodging is 100% deductible. Meals, on the other hand, are usually limited to a 50% deduction. However, for 2021 and I believe 2022 as well, meals from restaurants are going to be 100% deductible. This includes restaurant dining, takeout, and catering. This 100% deduction only applies to restaurants though. So if you cater from a catering place, a catering company, that is limited to the 50% deduction. That's not 100% deductible. It's best to keep track of and account for your meals and lodging separately, since there are different deductibility percentages. And as for documentation purposes, obviously receipts are always best. And for meals, you should document the business purpose and the guests that you brought with you to the restaurant or wherever you went, and their relationship with you. Entertainment. The Tax Cuts and Jobs Act no longer allows entertainment expenses to be deducted. However, meals are still deductible at these events if they are directly related to or associated with the activity of your business, and this is limited to the 50% deduction. Lastly, your home office deduction. This is also typically used for Schedule Cs and small business taxpayers, so small business corporations and partnerships. This deduction only applies to self-employed taxpayers and independent contractors. So although working from home these days is very common, employees that work from home do not get this deduction. It's very similar to the auto deduction in the fact that it has two methods. It has the actual expense method and it has the square footage method. In order to use this deduction, your home must be your principal place of business, and it should have a designated space exclusively for the use of conducting your business. If you're using the actual expense method, you need to keep record of all of your home expenses. So that includes your utilities, your internet, insurance, real estate taxes, mortgage interest, any general repairs such as to your roof or HVAC. Those should be kept. And similar to the auto deduction, we get a business percentage based on the square footage of your office space in your home and the square footage of your total home. And that business use percentage is multiplied by your home expenses to get your deduction. The square footage method, we use your home office space square footage, and that is multiplied by $5 that the IRS limits it to, and that goes to a maximum of 300 square feet. And that concludes the record keeping best practices to keep in mind for 2021. and going forward. So with that, I will pass it on to Michael to discuss new reporting requirements.
Great, Taylor. Thanks very much. Well done. I am Michael Slapnick, audit partner in the assurance and advisory group here at Scott & Company. I will be discussing the new reporting requirements as per the new suite of audit standards issued by the AICPA back in May of 2019. And the statements are statements on auditing standards 134 through 141. And they are effective for the calendar year ended December 31st, 2021 audits that we will start working on here early in 2022 and through to the spring. And SAS 134 is entitled Auditors Reporting and Amendments, including amendments addressing disclosures in the audit of financial statements. Generally speaking, the implementation of the standards will include significant changes to our audit engagement letters and final reports. As it pertains to engagement letters, the letters generally include largely the same information. One significant difference is that we will now document in the engagement letter what we have identified as significant risks of material misstatement. And that will obviously vary from one client to another based on where we see risk. As it pertains to the new audit report, again, the information contained in the report is generally not changed. One very significant difference, however, is the order of the information. The opinion, which most people would probably consider the most important piece of the audit report, will be the very first paragraph going forward. It's usually in the past, under the old standards, the opinion could be all the way down at the bottom of the first page and sometimes even on the second page, but this new standard will move it to the top. Another significant difference is there will be additional information provided by us regarding what an audit entails. For example, the report will explicitly state key audit matters, and that introduces kind of a new acronym, CAMS, K-A-M-S, and so you all will probably be seeing that if you are audited. And in the letter, we will explicitly state that we have to exercise professional judgment and maintain professional skepticism throughout our audits. We will state that we have to identify and assess the risk of material misstatement of the financial statements. We'll also discuss and specifically state in the audit report that we have to obtain an understanding of internal control in each entity that we audit. And we will also conclude whether in our judgment there are conditions or events considered in aggregate that raise substantial doubt about the company's ability to continue as a going concern for a reasonable period of time. So in conclusion, SAS 134 and these related standards will benefit the users of audited financial statements by placing the auditor's opinion at the front of the report for added visibility and to provide necessary transparency into the basis for the auditor's opinion and the responsibilities for both entity management and auditors. Thank you very much, everyone, for joining today, and I'm going to pass it over to Bill, who is going to discuss IRS red flags.
Thank you, Michael. Ideally, this section would have followed Taylor's, but that would have been too much tax in a row for most people, I think. So some of the things Taylor mentioned do raise some IRS audit red flags. They increase your likelihood of being audited. And this slide is primarily aimed towards both small businesses and Schedule C taxpayers. On the slide here, you see, what, 10 things. There's a couple other things that I'm going to run or mention. That is, like, one of the things I have ran into is rounded amounts on a Schedule C or a Schedule E rental property. I once had a client I picked up from another CPA, and after doing his return, pushing back on some of his numbers, later that year, he got an audit notice for the prior accountant's returns. During the course of working through the audit with the agent, I asked the agent, I said, what, spawned this audit? And she turned around, took the 2 Schedule E's, which there was a total of 6 properties on each Schedule E, section of Schedule E's. And she said, what do you see that looks fishy? And I said, well, most of these numbers end in 00, 500, 800, 1300, 1500. I said, it's kind of weird that you would have 5 properties and each one of them would have utilities of $400 or $500 or $600 a year. And each one of them would have this of 300 or 400 or 200 and that kind of stuff. I said, I've never seen an insurance bill for a piece of property end in 00. And she said, exactly. She said that keyed us into the fact that these numbers, for the most part, were made up. Sure enough, taxpayer can only support about half of them, and he got burned. So that's one thing that you got to watch out for. Make some other IRS red flags. Taking heavy auto business deductions. Please keep in mind that if you are deducting for your car, you can either use the mileage method that Taylor discussed or the actual expense method. You cannot also take mileage for a rental car. I had a taxpayer that did that to me once. He informed me that he drove 80,000 miles a year. And I'm like, well, where'd you get that number from? And he said, oh, well, that includes the mileage I drive with my rental car. That could have been a big problem if we would have reported that deduction and got audited. And trust me, with that big of an auto deduction, we probably would have gotten audited. Home office deductions, once again, that's a place that if you got that on return, it raises a red flag with the IRS. The concept of tax losses where you have a wage earning business operator who has a side business that the side business manages to lose $20,000, $30,000 a year. That's a problem. That'll probably get you a little letter from the IRS, which they'll inform you that they want to come visit you. A situation where you can mix both your business expenses and your personal expenses. That raises red flags to them. They actually have, through their processes over the years, they know certain guidelines that expenses fall in relation to income for different types of businesses. So, for example, if you operate a veterinary clinic as a Schedule C, they know you're going to have certain types of expenses versus if you operate a law practice. So hence, that's one of those things of they have a lot of what I guess you would call it in this day and age metadata in which they can make determinations, and their computers will run an algorithm against your return to pull that thing. The final one down here is to file incomplete returns. There's 2 questions on the tax return, and one is that did you file your 1099s? So if you're reporting, quote, independent contractor payments as a deduction, but you check that you did not file any 1099s because you probably forgot to file them, that's going to get you some type of attention. So those are some things that you need to watch out for in your return, or be aware of when you're getting your information to your CPA. And with that, I will pass it on to the next person.
Thanks, Bill. Good morning, everyone. I am Richard Bola, a member here at Scott & Company in the audit department. Here to talk to you a little bit today about new accounting standards. The last couple of years has sort of been quiet around new standards, where we saw a lot of our clients mostly focused on implementing the new RevRec standard, which had been delayed a couple of times, thanks or no thanks to COVID. And I think as a result of COVID, we've also had a fairly quiet year as it relates to new accounting standards. Accounting standards continue to, updates to the standards continue to be released on a regular basis. It's always difficult to keep up with those, so we recommend that you visit the ICPA website to at least get a general sense of what's happening. I think what we've seen with our clients is they're still working on 606 revenue recognition, and a lot of them are spending a lot of time on leases, and so that's more or less what we've seen. I know that for the financial institutions, 2016-13, the credit losses, which is effective for essentially calendar year end 12/31/2023 for financial institutions, it is still there, not yet adopted. So I think what we've seen in general is that the standards come out and then there are updates to them as we work through implementation. For 2021 so far, there's been 9 updates, and some of them are fairly small, nothing too major. There was just recently 2021-09 that relates to leases and discount rates for lessees that are not public business entities. And that is effective if you haven't yet adopted the new lease standard as of November 11th, then you're required to adopt the amendments in this update. But if you have, then it's effective for fiscal year year ends beginning after December 15, 2021. So roughly the 2022 going into 2023 year end. There is 2021-08 that relates to business combinations, accounting for contracts and contract liabilities from contracts with customers. This is not effective until fiscal years beginning after December 15, 2023, which essentially is the December 31st, 2024 year end. And then there is 2021-05 that relates to leases as well. Lessors, certain leases with variable lease payments, and that is effective for fiscal year beginning after December 15th, 2021. And then the other one that's probably worth mentioning, and this was issued in January of 2021, is 2021-02 that relates to franchisors as it relates to revenue from contracts with customers. So as I said, a lot of times the standards are issued and then there are updates as we work through adoption and transition. And so this one is it's essentially, if you haven't yet adopted 606, then there's some existing transition provision included in this update for franchisors. But if you have already adopted 606, then the amendments in the update are effective for periods beginning after December 15th, 2020. So that's most of it. Nothing too crazy in new accounting standards. I think as Don mentioned on the leases, that's one that we've seen a lot of our clients work through and make sure that they have the right information. And oftentimes I think underestimate the time and effort it takes to implement these new standards. So again, I recommend everyone sort of stay close to the ICPA website for those updates so you know what's happening and how it impacts you. And of course, I'll always work closely with your CPAs, because we tend to see them a lot more, even with the adoption and there are two components essentially to adoption of new accounting standards. There's the side of capturing all the data and making sure that you're making the right adjustments in your financial statements, and then there's the element of the financial statement disclosures. And so we tend to sometimes see the disclosures earlier than some of our clients. And so we are often able to help, at least give a basic template to help with some of those disclosures. But that is it for new accounting standards. I suspect that as we get through releases and everybody adopts 606, then we might see some bigger changes happening in terms of new accounting standards. So with that, I will pass it on to John to talk to you about IRS issued IP PIN. Thanks, everybody.
Thank you, Richard. So in 1986, the IRS decided to start a pilot program called e-filing. So that went on, that they got a whole 25,000 returns in that year from 3 preparers in some larger cities. And even then, the only returns that could be e-filed were those who were claiming a refund. So if you owed tax, you had to mail them a paper return. So we've come a long way in 35 years with the e-filing program, and it's a great thing to do. It saves a lot of trouble on multiple fronts. But one of the downsides to e-filing is there are people out there who decide, hey, I want to try to steal somebody's identity. I'm going to file a return with this social security number that I have somehow gotten my hands on. So if you've ever had to try to e-file your tax return and you get this phone call or email from your preparer saying, your return was rejected because somebody's already filed a return using your social, you have to, there's no way to e-file a return. It has to be paper filed. And then you have to pretty much get in touch with the IRS to let them know, hey, I am who I say I am. And then when they agree to that and say, yep, we realize now that we've gotten a bogus return with your social on it, the IRS issues what they call an IPIN. And it's a 5 or 6 digit number that you get a notice for every year that you either enter in your own software or you have to give to your tax preparer that lets the IRS know, hey, you know, this is who I say I am. So that's been going on for a number of years, but now the IRS has decided, hey, we're not just going to hold this to people who have had this issue already, but who may want to avoid this issue. You know, there are some people who have had been the subject of credit card fraud or other things, bank fraud, and they're like, hey, I just want to go ahead and use this feature. And so the IRS is giving you a way to get an IPIN. And what you do is you go to the IRS website, that's irs.gov, type in the search box IPIN, and that will take you to the place where you can apply for one. You will have to answer a series of questions that presumably you only know the answer to and match up with what they have in their records to verify that, yep, this is the person that should be receiving this PIN number from us. And like I said, when you start this process, you will get a new one every year. You cannot reuse a PIN, and you will get a letter from them in January saying, here is your PIN for this year and this year only. So it's not a bad thing. It's just, it gives you as the taxpayer another level of security to know that somebody cannot file a return using your social and then having to go through the trouble of having to paper file a return and then prove the IRS, yeah, I am who I say I am, and so on and so forth. So I would encourage you to look into this if if you've had an issue before with something other than your tax return. It may be, I've already had a couple of clients have told me that they have already done this. And so it is pretty simple on their website. With that, Bill and I will talk about some year-end tax planning ideas.
Okay. For 2021 and 2022, barring any changes in the soon to be legislative session for 2022, you're still eligible to claim bonus depreciation, which is 100% bonus. So that is a opportunity to obtain a deduction if you can, need to buy equipment. By the way, based on what I'm hearing, good luck on finding said equipment. It's probably stuck on a boat somewhere or awaiting a chip to be installed. But I've had several taxpayers tell me that they would like to buy certain pieces of equipment, but the time lag is 3 to 6 months. That becomes important in 2022 that if you're still waiting on that equipment, because there are actually some binding exception rules that if you enter into a contract to purchase a piece of equipment and it is not yet installed, that you can still qualify for bonus under the old rules and possibly in 2023. John will just, the other thing is typically in most years, we tell people to accelerate deductions and postpone income. The problem is with the current legislative environment, you only do that is if your income tax brackets are going to stay the same. So consequently, it could be that this year you want to postpone deductions because if the SALT cap for 2021 is not lifted, but the SALT cap for 2022 is lifted, then you would obviously want to push your state income tax deductions for your fourth quarter estimate and or your property tax payments into 2022. By the same token, if the tax rates are going to be higher next year, you probably want to go ahead and pick up whatever income you can pick up this year, including possibly taking your capital gains at a lower, the current rate, which might very well be lower than the future rate. And then the last three, John's going to discuss.
Well, what I want to mention about charitable contributions is for those folks who do not itemize their deductions because they just don't have, say, no, they don't have any mortgage interest any longer, or again, they have that SALT cap problem. There's two ways to help out on charity. First, for this year and this year only, if you don't itemize your deductions, but you give at least $600 of cash contributions to a charity, you will get to write those off on top of your standard deduction. In 2020, it was $300. This year, it's $600, and then after this year, that goes away. The other thing that people can do for retirees who have already had to start taking their required minimum distributions is you are allowed to make charitable contributions directly from your plan as part of your RMD, and then that counts as having taken it out of your plan, but you don't pick it up as income, and the check is directed directly to the charity. Most places will mail it to you, and then you turn around and give it to the charity, but you don't take it as a deduction, but you don't pick it up as income. So it's kind of a way to get your cake and eat it too on those in that area. If you don't have a retirement plan, this is the time to look into establishing one. Simply you can just do an individual retirement account, and you can put up to about $6,500 in that as on yourself. Or if you're a small business and you might have few employees and you want to help them out too, you could set up a simple plan or a 401k. So some of the stuff has to be done by the end of the year. So you need to, talk to your financial advisor about whether or not which plan might makes most sense for you. And again, as Bill said, you just want to look at, I have had clients that will generate some income because they want to use that particular tax bracket that they're in and maximize that, because if you're in the, say, the 24% bracket and you have some income that you might say, oh, I can defer it to next year, but then I might end up being taxed at a higher rate, then let's go ahead and use up the rest of that 24% tax bracket before it goes up into the 32% bracket. So you just need to kind of get a overall look at where you are. And this is a good time to do it because you got about 6 weeks or so to kind of figure that out and take advantage of tax brackets as well as other items. Now, I don't know if we had any questions that were posed to the panel, but if not, and
Well, John, I got one other thing.
Okay.
For those of you who want to know more about that active trader business income, I'm actually making a CPE presentation downstairs tomorrow at noon. But more importantly, in connection with that CPE presentation, Taylor and I have created a probably 40 to 50 slide deck that goes through the South Carolina revenue ruling, which, by the way, is not final. It is draft, but the comment period ends next week, and I don't think there's been too much in the way of comments. But anyhow, we've got a slide deck that discusses that, and the beauty of the slide deck is Taylor has actually keyed it to the questions in the document, because there's about 30 questions that the document goes through. So each slide pertains to a question. So if you just kind of scan the slide, you can figure out, okay, this is a question I got. Go to that slide, go to that question in the document, read the document, figure out what's going on, and you're good to go. So if anybody needs that or wants to see that, please send me an email and I will get it to you sometime tomorrow, probably.
All right, thanks, Bill. And I want to thank everybody for attending our webinar today. Again, feel free to complete the survey and to let us know how we did and what we can do in the future to help you with any accounting and tax needs. Thank you very much and have a great day.